Many traders enter financial markets with the belief that success depends on discovering a perfect strategy. This belief often leads them into a long and exhausting search for the ideal indicator, the flawless system, or the secret combination of tools that can predict market movements with high accuracy. In the early stages of learning, traders frequently experiment with many different strategies. They test new indicators, follow different mentors, watch countless tutorials, and attempt to combine multiple techniques into a single system. Each new method appears promising at first, especially when it is presented with confident explanations or impressive examples of profitable trades. However, this constant experimentation often creates a cycle where traders repeatedly abandon one strategy for another. Instead of mastering a single approach, they continuously modify their methods, hoping that the next adjustment will finally produce consistent results. Over time, this search for perfection creates confusion rather than clarity. The desire to improve results is natural, but the process often becomes counterproductive. Every new indicator or rule added to a trading system increases its complexity. Traders may begin with a simple concept, such as identifying trends or support and resistance levels, but gradually they add multiple indicators, filters, and confirmation signals. Eventually, the chart becomes crowded with information that attempts to explain every possible market movement. Ironically, the more tools traders add, the more difficult it becomes to make clear decisions. Instead of simplifying the trading process, excessive tools create uncertainty about which signals should be trusted. Traders may find themselves waiting for many different conditions to align before taking a trade, and when those conditions conflict, hesitation appears. Information overload plays a major role in this problem. The modern trading environment provides unlimited access to information. Social media platforms, online courses, forums, and video content constantly present new strategies and opinions about how markets should be traded. While this access to knowledge can be valuable, it also exposes traders to a wide range of conflicting ideas. One educator may emphasize price action, another may focus on technical indicators, while others may promote algorithmic strategies or fundamental analysis. Each approach is often presented as the most effective path to profitability. For a developing trader, this flood of advice can be overwhelming. When every source claims to offer the best method, it becomes difficult to determine which information truly matters. As traders attempt to combine these different perspectives, their systems often become more complicated. They might attempt to merge several strategies together, believing that additional confirmation will improve accuracy. However, conflicting signals frequently appear when multiple methods are used simultaneously. One indicator may suggest a buying opportunity, while another signals a potential reversal. This conflict creates hesitation at the exact moment when clear decisions are required. Instead of acting with confidence, traders begin questioning their analysis and delaying their actions. The relationship between complexity and consistency is often misunderstood in trading. Many traders assume that a more complex system must be more advanced and therefore more effective. In reality, complexity frequently reduces consistency. The more rules and conditions a system contains, the more difficult it becomes to execute the system exactly the same way every time. Even small variations in interpretation can lead to different decisions. A trader may follow the rules strictly on one trade but interpret them differently on the next. Over time, these inconsistencies weaken the reliability of the strategy because results are no longer produced by a repeatable process. Execution mistakes also become more common when trading systems are overly complicated. During live market conditions, traders must interpret information quickly while managing risk and emotional pressure. If a system requires monitoring numerous indicators, confirming multiple signals, and analyzing several timeframes simultaneously, the decision-making process becomes slower and more stressful. Important opportunities may be missed simply because the trader is still evaluating too many variables. In other cases, the trader may act prematurely because the system feels too complicated to follow perfectly. These execution errors gradually reduce trading performance, even if the strategy itself appears logical in theory. Overcomplication also carries a hidden psychological cost. When traders rely on complex systems with many moving parts, their confidence in decision-making often decreases. If a trade loses, it becomes difficult to determine which part of the system failed. Was the indicator misinterpreted? Did one of the confirmation signals appear too late? Or was the strategy itself flawed? This uncertainty can lead traders to question their entire approach after a small series of losses. As confidence weakens, emotional pressure increases. Traders may hesitate to take valid setups or abandon their system prematurely in search of something better. Delayed reactions to market opportunities are another consequence of complex trading methods. Markets move continuously, and opportunities often appear for a limited period of time. When traders rely on many confirmation signals, they may wait so long for perfect alignment that the opportunity disappears. By the time every condition is satisfied, the market may already have moved significantly. This delay not only reduces profit potential but can also increase risk because entries occur after the most favorable prices have passed. The emotional pressure created by complexity can become significant during active trades. When traders must constantly monitor multiple indicators and conditions, their attention becomes divided. Instead of focusing on the broader structure of the market, they become absorbed in small details that may not significantly influence the overall trend. This constant monitoring can create anxiety, especially when different signals begin to conflict. The trader may feel uncertain about whether to hold the position, adjust the trade, or exit early. These doubts often lead to impulsive decisions that disrupt the original trading plan. The deeper insight behind these challenges is that trading performance often improves when unnecessary complexity is removed. Simplicity does not mean ignorance or lack of knowledge. Instead, it means identifying the few principles that truly matter and focusing on executing them with consistency. Many successful traders rely on relatively simple frameworks such as understanding market structure, recognizing trends, and managing risk effectively. These core principles allow traders to interpret price movements without relying on excessive indicators or complicated formulas. Clear principles simplify the decision-making process. When traders understand exactly what conditions they are looking for, they can evaluate the market more quickly and confidently. Instead of analyzing dozens of variables, they focus on a small number of meaningful signals. This clarity reduces hesitation and allows decisions to be made with greater precision. Simplicity also supports the development of consistency. A straightforward trading plan is easier to follow repeatedly because the rules are clear and manageable. When traders execute the same process over many trades, they gain valuable feedback about what works and what needs improvement. This feedback becomes difficult to obtain when systems change constantly or contain too many variables to measure accurately. Ultimately, the goal of trading is not to create the most complex system possible, but to develop a process that can be executed reliably under real market conditions. Financial markets will always contain uncertainty, and no strategy can eliminate risk entirely. However, when traders reduce unnecessary complexity and focus on clear, repeatable principles, they create an environment where disciplined execution becomes possible. Over time, this consistency often proves far more valuable than the endless search for a perfect strategy. In the complex and often unpredictable environment of financial markets, clarity becomes one of the most valuable advantages a trader can possess. Prices move quickly, information flows constantly, and new opportunities appear and disappear within seconds. In such conditions, traders who rely on complicated systems or vague ideas often struggle to make confident decisions. One of the most powerful ways to reduce confusion is by relying on a single guiding rule or principle that shapes every trading decision. This rule does not need to be complicated or technical. In fact, its strength often lies in its simplicity. A single clear principle can act as a stable reference point when the market becomes uncertain, allowing traders to filter information and respond with greater confidence. A guiding rule provides clarity because it simplifies how traders interpret market conditions. Instead of trying to evaluate dozens of indicators, signals, and opinions at the same time, the trader focuses on a single foundational idea. This principle becomes the core lens through which every potential trade is examined. For example, a trader might prioritize trading only in the direction of the prevailing trend or entering trades only when specific structural conditions appear in the market. Regardless of the specific rule chosen, its purpose is to create a consistent filter. When the market presents a possible opportunity, the trader asks a simple question: does this situation align with the guiding rule? If the answer is yes, the opportunity can be evaluated further. If the answer is no, the trade is ignored. This filtering process dramatically reduces the number of impulsive decisions that occur during active trading. The value of a single guiding rule becomes even more evident during fast market movements. When prices begin moving rapidly, traders often feel pressure to react immediately. Without a clear framework, this urgency can lead to hesitation or impulsive entries. Traders may second-guess themselves, wondering whether the move will continue or reverse. A guiding rule reduces this hesitation by providing a clear reference point. Instead of reacting emotionally to the speed of the market, the trader simply checks whether the situation matches the predefined principle. This clarity allows decisions to be made more quickly and with greater confidence. However, a rule only becomes powerful when it is applied consistently. Many traders understand useful principles but struggle to follow them in real time. Consistency is what transforms a simple idea into a practical advantage. When traders repeat the same behavior over many trades, discipline begins to develop naturally. Each trade becomes part of a larger process rather than an isolated decision. Over time, this repetition strengthens the trader's ability to follow their rules even when emotions attempt to interfere. Consistent execution also produces measurable outcomes. In trading, improvement depends on the ability to evaluate performance accurately. If a trader constantly changes strategies, rules, or decision criteria, it becomes impossible to determine what is actually working. By applying the same guiding rule repeatedly, traders create a clear pattern of behavior that can be analyzed. They can review past trades and identify whether the rule is producing favorable results or whether adjustments are necessary. Without this consistency, trading becomes a series of unrelated actions rather than a structured learning process. Another critical benefit of clear rules appears during periods of intense emotional pressure. Financial markets frequently create situations that trigger strong psychological reactions. Rapid price movements, unexpected reversals, and sudden volatility can cause traders to feel fear, excitement, or frustration. These emotions often lead to impulsive decisions, such as entering trades too quickly or exiting positions prematurely. Clear rules act as a stabilizing force in these moments. Instead of allowing emotions to dictate actions, the trader follows a predefined structure. The rule becomes a reminder that decisions should be based on logic and preparation, rather than immediate feelings. This structured approach replaces emotional reactions with disciplined behavior. When traders know exactly what conditions must be present before they act, they are less likely to respond impulsively to every market fluctuation. The rule acts as a boundary that protects them from unnecessary risks. Even when the market becomes chaotic, the trader continues following the same decision-making process. Over time, this habit of structured thinking becomes deeply ingrained. Simplifying the trading process is another major advantage of relying on a guiding rule. Many traders attempt to analyze too many variables simultaneously. They monitor several indicators, watch multiple timeframes, and attempt to interpret various opinions about the market. This overload of information divides attention and makes decision-making slower and more stressful. When traders reduce the number of variables they consider, their focus improves significantly. A single guiding rule narrows attention to the most relevant aspects of market behavior. With fewer variables competing for attention, traders spend less time second-guessing their decisions. Doubt often arises when traders attempt to evaluate too many factors at once. One signal may suggest entering a trade while another suggests waiting. This conflict creates hesitation and uncertainty. A simple rule removes much of this conflict by clearly defining what conditions matter most. When those conditions appear, the trader acts. When they do not, the trader waits. This clarity reduces mental fatigue and allows traders to concentrate on executing their plan effectively. As the trading process becomes simpler, it also becomes easier to follow consistently. Complex systems often require constant adjustments and interpretation, which increases the likelihood of mistakes. Simple frameworks, on the other hand, can be executed more reliably under real market conditions. Traders are less likely to forget rules or misinterpret signals because the process is straightforward and easy to remember. Over time, this simplicity leads to stability in decision-making. Clear rules create a structured framework that traders can rely on regardless of market conditions. Instead of reacting differently to each situation, They approach every trade with the same methodical process. This stability reduces emotional fluctuations because traders know exactly what they are supposed to do. Even when a trade results in a loss, the trader understands that the decision followed a defined rule rather than an impulsive reaction. This stable decision framework gradually strengthens long-term confidence. Confidence in trading does not come from winning every trade, but from trusting the process behind each decision. When traders consistently follow their rules, they begin to see how their strategy performs across many different market conditions. This experience builds a deeper understanding of both strengths and limitations. As confidence grows, traders feel less pressure to constantly search for new strategies or external validation. Confidence also reinforces discipline. When traders believe in the value of their process, they are more likely to follow it faithfully. Discipline becomes less about forcing behavior and more about maintaining a system that has already proven its reliability. Over time, this combination of clarity, consistency, and confidence creates a strong psychological foundation for long-term trading performance. Ultimately, the power of a single guiding rule lies in its ability to simplify complex decisions. Financial markets will always contain uncertainty, but traders who rely on clear principles can navigate that uncertainty with greater stability. Instead of becoming overwhelmed by endless information or reacting emotionally to every price movement, they follow a structured approach that supports consistent execution. Through repetition and discipline, this simple rule becomes a powerful tool that helps transform trading from a chaotic experience into a controlled and sustainable process. A single guiding rule in trading does more than simplify decision-making, it directly improves overall trading performance. Financial markets present countless opportunities, signals, and opinions at any given moment, and without a clear framework, traders can easily become overwhelmed by the constant flow of information. When traders rely on one clear rule that guides their actions, the trading process becomes more structured and predictable. Instead of reacting impulsively to every movement in the market, decisions are filtered through a consistent principle. Over time, this approach strengthens risk management, improves trade selection, stabilizes emotions, reduces overtrading, and develops consistent behavioral patterns that support long-term success. One of the most immediate benefits of following a single rule is stronger risk management. In trading, protecting capital is far more important than chasing profits. Without a structured rule, traders often adjust risk levels based on emotion. After a winning trade, they may increase their position size out of excitement, believing that the market will continue rewarding them. After several losses, they may also increase risk in an attempt to recover quickly. Both reactions can expose trading capital to unnecessary danger. A clear rule defines acceptable risk levels before any trade is placed. It establishes boundaries that determine how much capital can be exposed on a single trade and how losses should be controlled. When traders consistently follow these limits, they prevent individual trades from causing severe damage to their accounts. Even during losing streaks, controlled risk ensures that the trader remains financially and psychologically capable of continuing. This protection significantly reduces the probability of large, unexpected losses that can destroy months or years of progress. Strong risk management also creates a more stable trading environment where outcomes are manageable rather than extreme. Another major improvement appears in trade selection. Financial markets generate continuous price movement, but not every movement represents a meaningful opportunity. Traders who lack a clear rule often interpret many small fluctuations as trade signals. This leads them to enter positions based on weak or incomplete setups. A guiding rule acts as a filter that separates high-quality opportunities from random market noise. When a trader evaluates the market, the rule becomes the first checkpoint. If the situation does not meet the defined conditions, the trade is ignored. This filtering process naturally reduces the number of trades taken. While some traders worry that fewer trades might mean fewer profits, the opposite is often true. When traders focus only on opportunities that meet their rule, the overall quality of trades improves. Instead of reacting to every minor movement, they participate only when the market presents a clearer and more structured setup. As a result, trade frequency becomes more controlled, and each decision carries a stronger logical foundation. The influence of a guiding rule also extends deeply into emotional stability. Trading often triggers strong emotional reactions because money and uncertainty are involved simultaneously. Rapid price movements can create excitement when trades move in the trader's favor and anxiety when positions begin to lose value. Without a clear structure, these emotions easily influence decision-making. Traders may close trades too early because they fear losing profits, or they may hold losing positions too long because they hope the market will reverse. When a rule guides the decision process, emotional reactions become less dominant. The trader does not need to constantly question whether an action should be taken because the rule has already defined the conditions. Decisions become less about personal feelings and more about following the established framework. This shift reduces stress during trades because the trader no longer feels responsible for predicting every market movement. Instead, they focus on executing the rule consistently. Balanced emotional reactions also develop as traders gain experience following the same principle repeatedly. Wins are no longer interpreted as proof of personal skill, and losses are not seen as personal failure. Both outcomes are simply results of applying the rule within an uncertain environment. This balanced perspective helps traders maintain composure during both profitable and difficult periods. Another significant benefit of using a single rule is the reduction of overtrading. Overtrading is one of the most common problems in financial markets. It occurs when traders feel the need to constantly participate, even when the market does not provide clear opportunities. The continuous movement of price can create the illusion that profitable trades are always available. Without a structured rule, traders may open positions simply because they do not want to miss potential gains. A guiding rule introduces discipline into this environment. Because trades must meet specific conditions, many market movements are automatically ignored. This restriction encourages patience. Traders become comfortable waiting for the right setup instead of forcing trades out of boredom or impatience. As patience improves, trading activity becomes more deliberate and purposeful. Reduced overtrading also lowers transaction costs and minimizes the number of unnecessary mistakes. Every trade carries risk, and taking too many trades increases the probability of errors. By focusing on fewer but more carefully selected opportunities, traders preserve both their capital and their mental energy. This deliberate approach allows them to analyze the market more thoughtfully and maintain a clearer perspective during trading sessions. Perhaps the most powerful long-term advantage of following a single rule is the development of consistent behavioral patterns. Human behavior plays a major role in trading outcomes. When traders make decisions randomly or based on emotions, their behavior becomes unpredictable. Each trade may be executed differently, making it difficult to evaluate performance accurately. A guiding rule introduces repetition into the decision-making process. Every time the trader follows the rule, they reinforce the same pattern of behavior. This repetition gradually strengthens good habits such as patience, discipline, and careful risk management. Over time, these habits become automatic. Instead of struggling to control emotions during each trade, the trader naturally follows the same structured process. Good habits eventually create stable performance patterns. While individual trades may still produce wins or losses, the overall behavior of the trader remains consistent. This consistency allows results to reflect the true effectiveness of the trading strategy rather than random emotional reactions. When behavior becomes stable, traders can analyze their performance more accurately and make meaningful improvements to their methods. In the long run, the greatest benefit of a single guiding rule is not simplicity alone, but the stability it creates in every aspect of trading. Risk becomes controlled, trade selection becomes more selective, emotions become balanced, and habits become consistent. These improvements combine to produce a more disciplined and sustainable trading approach. Instead of relying on complex systems or constant experimentation, traders develop a clear framework that supports steady growth and long-term participation in the market. Following one clear rule in trading can create powerful long-term changes in both behavior and performance. Many traders believe that improvement comes from constantly adding new indicators, testing different strategies, or searching for more complex systems. While learning new concepts can be valuable, the true transformation in trading often comes from mastering simplicity and applying it consistently. When a trader commits to following one well defined rule, the trading process becomes structured, disciplined, and easier to evaluate. Over time, this structure leads to consistent performance, improved risk control, stronger confidence, and the ability to adapt to changing market environments. One of the most important long-term impacts of following a single rule is the development of consistency in performance. Financial markets are naturally unpredictable, and no trading method can eliminate uncertainty. Individual trades will always produce a mixture of wins and losses. However, when traders follow a clear rule consistently, their behavior becomes structured and repeatable. Each decision is made using the same criteria, which removes much of the randomness that often appears in emotional trading. Instead of making decisions based on feelings or sudden reactions, the trader follows a defined process every time a potential opportunity appears. This structured behavior gradually produces more stable outcomes. While profits may not appear instantly, the overall performance pattern becomes smoother and more predictable. Traders who follow clear rules experience fewer dramatic swings in their results because their actions are not constantly changing. Reduced emotional volatility also plays a major role in improving long-term performance. When traders react emotionally to every gain or loss, their decisions often become inconsistent. One trade may be managed carefully, while the next is influenced by frustration or excitement. By relying on a rule instead of emotions, traders maintain a steadier mindset, which supports more reliable execution over time. Another critical advantage of following a single rule is improved risk control. Many trading failures occur not because the strategy itself is flawed, but because risk management is ignored during moments of emotional pressure. A trader who experiences a series of losses may suddenly increase position size in an attempt to recover quickly. Similarly, a trader who feels confident after several profitable trades may begin taking larger risks without proper analysis. These behaviors can expose trading capital to unnecessary danger. A clear rule establishes boundaries that protect the trader from these impulsive decisions. When risk levels are defined in advance and applied consistently, capital preservation becomes a priority rather than an afterthought. Instead of focusing solely on potential profits, the trader concentrates on maintaining stability and protecting the account from large losses. Losses become manageable because they remain within predefined limits. This controlled environment allows traders to survive difficult periods without experiencing catastrophic drawdowns that could end their trading career. Following one rule consistently also builds confidence through discipline. Confidence in trading does not come from winning every trade because losses are an unavoidable part of the process. True confidence develops when traders trust the system they are following. When a rule is applied repeatedly over many trades, traders begin to understand how it behaves in different situations. They see how the rule performs during strong trends, quiet markets, and volatile conditions. This repeated experience builds familiarity and trust in the process. As trust grows, hesitation begins to decrease. Many traders struggle with decision-making because they constantly question whether they are making the right choice. Doubt often appears when strategies change frequently or when traders rely on too many conflicting signals. A single rule removes much of this uncertainty by providing a clear reference point. When the rule's conditions appear, the trader acts. When they do not, the trader waits. This clarity reduces second-guessing and allows decisions to be made with greater confidence. Another important benefit of a well-defined rule is adaptability across different market conditions. Financial markets constantly shift between various environments. At times they trend strongly in one direction, while at other times they move sideways or experience sudden volatility. Traders who rely on complex systems often struggle when conditions change because their strategies are designed for very specific scenarios. When the environment shifts, the system may stop functioning effectively. A strong guiding rule, however, is often built on broader principles that remain relevant across different conditions. Instead of focusing on narrow signals, the rule provides a framework for interpreting market behavior. Because the rule is simple and clearly defined, traders can apply it in different contexts without becoming overwhelmed by complexity. Structured thinking allows them to observe how the market environment is changing and adjust their actions accordingly. This adaptability does not mean abandoning the rule. Instead, it means applying the same principle while recognizing how market behavior evolves. Traders who think in a structured way can remain flexible without losing discipline. They respond to changes logically rather than reacting emotionally to every shift in price movement. Ultimately, the long-term lesson of disciplined trading is that success rarely depends on complexity. Many traders assume that advanced strategies and sophisticated indicators are the key to consistent profits. In reality, complexity often creates confusion, hesitation, and emotional pressure. Clear principles, on the other hand, simplify the decision-making process and strengthen discipline. A single well-defined rule can transform the way traders approach the market. It provides clarity during uncertainty, stability during volatility, and structure during emotional moments. Instead of constantly searching for better indicators or new strategies, traders begin focusing on executing one principle with consistency and patience. In the end, the most important transformation in trading often begins with simplicity. Many traders spend years searching for perfect strategies or powerful indicators that promise better results. Yet the real improvement frequently comes from committing to a simple rule and following it with discipline every time an opportunity appears. Trading success is rarely about doing more, analyzing more, or adding more complexity. It often comes from doing fewer things, but doing them consistently and with clear intention. When a trader commits to one guiding principle and applies it with patience and discipline, that single rule can reshape decision-making, strengthen habits, and ultimately improve long-term trading results.